All right, folks, this past Friday, we got a banger of a jobs number here in Canada. This is definitely going to impact the Bank of Canada's outlook. However, it's not going to change it. They were expecting things to start to firm up as we go forward. So this just kind of plays to their hand. I'd be surprised if they do anything this Wednesday. I don't expect them to do anything at all. They might not even comment on the recent strong number. But if they do, they'll just say, it's in line with their expectations. South of the border, the U.S. is expected to cut interest rates this Wednesday. So that could have an impact on mortgage yields in Canada. But going forward from here, we're kind of forming the bottom. And what I like to say, the major pivot point here in Canada with regards to mortgage rates, it could take 6 to 12 months before we see another move by the Bank of Canada. And right now the market is expecting the next move to be an interest rate hike, a year out. So that's kind of gives you an idea that we are at a pivot point in interest rates in Canada. Do I expect interest rates to scream higher over the next few years? No, I do not. I expect them to form a bottom in 2026, maybe tick up a little bit in 27, 28. And then I get very nervous as we head into the next U.S. election at the end of 28, because if politics moves to the left, because the U.S. is unhappy with the Trump presidency, then that is going to have a huge impact on asset prices. And evidently, it could force the government to either continue quantitative easing or start it at that point. And that will be very inflationary for assets. At that point, you want to hold real assets like real estate. So that's kind of where I'm at. 2026 is shaping up to be the bottom in this move down in interest rates. So if you're thinking about what you should do with your mortgage rate, I'm now advising clients, if they typically would go with a fixed rate, to go with a fixed rate. I think a 3-year fix makes sense because, like I said, 28, 29 is going to be another pivot point in macroeconomics. So that gets you to there. But if you always just go 5-year fix, there's nothing wrong with that as well. So that's kind of where we're at. Variable, if you're planning on making a move in the near term or breaking your mortgage, or you like to go variable all the time, there's still, a good reason to be variable, because the outlook could be wrong. What I mean by that is if the U.S. pulls out of the North American trade agreement, like they're threatening to do next year, that could, have another toll on the Canadian economy. And it could derail this whole outlook of Canadian interest rates bottoming in 2026. And we could see another leg lower in the Canadian economy, which would then argue for maybe a couple more interest rate cuts in Canada. So it's not a foregone conclusion that the bottom is in Canadian interest rates, but right now it's shaping up to be. Hope this helps everyone. Have a great day. Take care.